Welcome, everybody, and good morning, wherever you are in the world. This is Jason Hartman, and I've got Adam here with us, and the gold color already says good morning. You are so fast. Wow, that took like 10 seconds to get the first good morning. Post your questions and comments if you like. We will try to get to all of them. This is rather than our normal coffee talk that we do on Sundays. This is a little bit more of a presentation, a podcast episode and I believe we're on episode 1557, if I'm not mistaken. And I wanted to talk today about the booming southeastern real estate market. And just you're going to be astonished because Adam has put together some slides and some info, and it is just going to amaze you at the inventory statistics. The inventory statistics will blow your mind. Are you ready to have your mind blown? Adam, are you ready to blow some minds?
Oh yeah, let's do it. This blew my mind, which is why I put the slides together.
Yeah, good for you. Well, hey, before we start, I just want to remind everybody that real estate is the ideal investment. Income property is the ideal investment. Why? Because as it says on the screen, it offers income, depreciation, equity growth, appreciation, and leverage. It's a multi-dimensional asset class. And what drives me crazy, and Adam, I bet it drives you crazy too, is that, when you're on YouTube, by the way, you get some just wacko comments, like people that you can really tell sometimes, like, what are these people thinking? I know it's present company excluded, but you always get some comments. Oh, you're crazy to be talking about real estate right now. Real estate is going to crash. It's going to collapse. The economy is falling apart. That's not completely false, but it's mostly false. There's some truth to it for sure. I get it. We do not live in a bubble here, folks. We know what's going on in the world. I'm constantly reporting what's going on in the world. But here's the thing. It's a multi-dimensional asset class. And the culture of the entire world seems to be stuck in this one-dimensional asset thinking, which is buy low, sell high. That's it. Buy low, sell high. Folks, that's only one part of our return on investment compilation here, right? It's a multi-dimensional asset class. And of course, we've talked about market timing, which is a fool's errand.
Yeah.
Adam, go ahead.
I was going to say market timing makes most people do the one-dimensional asset of buy high, sell below.
You're right. That market timing usually does lead to that, but I want to even compare it to successful market timing, which is so rare. It is extremely, extremely rare. But even with successful market timing, it still doesn't win the strategy of just buy good properties and hold on for the long term. That's the winning strategy. So anyway, this is just a reminder that income property is, of course, the ideal investment. And remember that acronym IDEAL, IDEAL, income, depreciation, equity growth, appreciation, and leverage. And by the way, for those new to income property investing in the most historically proven asset class in the entire world, when I say depreciation, I mean that in a good way, right? It's good. Depreciation is the world's best tax benefit. It is a phantom write-off. It is a non-cash write-off. It's a tax benefit you get without writing a check to get
Voodoo depreciation.
Yeah. Voodoo depreciation. I like it. That's good. All right. So let's dive into Adam's content here. And of course, welcome. If you have any questions, reach out to us through jasonhartman.com. If you're in the United States watching or listening, call us at 1-800-HARTMAN and we can get you there. Adam, so here is a map. Now, this is a a photo. What are you reading the newspaper or
I read a
magazine?
physical book. Can you believe this? I read a physical book.
Yeah, a physical book. Okay, so a book on, what is that? Is that made of
This is
paper?
this is friend of the show John Burns's
Yeah,
The Big Shift that
yeah,
he gave out at the Meet the Masters back I think 2 years ago,
right.
and I finally got around to actually reading it.
Ah, slacker,
Well,
slacker.
it wasn't on Kindle. It takes a while.
Oh, oh, so
But
so in other words, if it's on if it's an ebook on a Kindle or some other device, then you read it more quickly than you read a physical
yeah,
book.
yeah, I would
But
say that's
no,
probably true.
no, why is that?
I don't know, just ease of use, I guess. I don't know.
Yeah.
I don't
Okay.
know.
All right. So what does this tell us? What does this map photograph
Yeah.
tell us? This map of the United States as
So
a photo.
one of the big things they were talking about is household growth. As people move, we've talked about, and you've talked about on the show, how people are still living with their parents, and moving back in with them. And when they go out, they form new households. They're not new people, but they're forming new households. So household growth is both people moving out for the first time and people moving out for the second time, and divorces happening and creating new households. And this is showing where people have been forming households in terms of demographically where they're moving. And if you look here, you actually have the Southeast, and then Texas and Florida throw everything off so much they have to make their own category for
Yeah.
them,
Wow.
because
Wow.
the Southeast, where we have a lot of our investing portfolios that we're building up for people, that grew at 33%, as opposed to, your California was 21. If you look here, your Northeast is only 13%. So everything's growing because we're getting more people. But if you look at the pace of growth, the Southeast is growing at it looks like it's about 1.25 times faster. So 25% faster than the rest of the country. And Texas and Florida are nearly double the rest of the country. This is why when we talk about the cyclical markets in the West Coast and the Northeast, when we talk about the hybrid markets and the linear markets, this Southeast stuff, a lot of that is the linear markets, and you're still outgrowing the rest of the country. It's incredible.
What's interesting about this, that it's just a sort of a broad takeaway from this map. And by the way, thank you for getting this together, because it's really interesting. One of the broad takeaways would be that the money it's what I was saying 16, 17 years ago. I call it the water theory of money, right? You've got this water bottle, you pour it out, and what does the water do, right? The old saying is water seeks its own level. And so the water flows to the lowest point. And this shows you that that's happening, right? Because these lower priced markets, the business friendly areas of the country, the right to work states, mostly, where you're not forced at gunpoint to join a union, and if you want to get a job, the most ridiculous idea ever. That's where the lion's share of the growth is. Now, what's interesting is that, like you said, Texas and Florida get their own separate category. They're not even regionalized. They're so big. Texas, 47% household formation growth. Florida, 45%. You're in Texas. I'm in Florida. I used to live in the Socialist Republic of California at only 21%. So Texas, more than double. Florida, more than double California. And these are, more than triple what's happening in the expensive Northeastern markets, all mostly business unfriendly. It really shows you just the general vibe, right? The vibe. How's that for a technical term? Of what people are thinking and what they're doing.
Yeah. Now the Southwest grew the fastest, so I'll admit that. But for the most part, if you look at those states, those are states that don't make sense at the moment. So it'd be great if we could get into the Southwest, but we can't.
Yeah. And so what Adam means by that is that, if you can't get a good rent to value ratio on the properties, then we're not going to be interested in those markets. The Southwest is great, but again, it got too expensive. Many times over the years, we've been in and out of the greater Phoenix metro area, because there were times when that market did make sense and you could get a reasonable rent to value ratio. But again, most of those markets just don't work. So we got to go where it makes sense, where the growth is. And this is really interesting. You did allude to divorce, and I just want to talk about the D word for a moment. I've mentioned this over the years on the podcast, but one of the things that I want you to consider now, this is a little bit conspiratorial, I'm going to admit, but just think about it. If you have a country, right, and you want the economy to grow, or if you have a company, a major company, right, and you want to grab more market share, right, for your consumer products. If you have a consumer, yeah, Adam, you know what I'm going to say because you're chuckling at this, right? But it's really true. If you sell sofas, coffee makers, refrigerators, toasters, whatever, right? Or if you're a home builder and you sell houses, and if you're in government and say you're the president of the country or you're Congress or whatever, right? Or you're a congressperson. Dare I say, don't say congressman, say congressperson. Thank you. PC here. Think about it. If you want the economy to increase in size, or if you want your market share to increase in size, you should discourage marriage and you should encourage divorce. Because think about it. When someone isn't married, or if they are married in one household and then they become divorced, you've literally doubled your demand for whatever your product is, right? If you sell toasters, now you got to have two toasters because you have two households. You got to have two sofas because you have two households. You've got to have two coffee makers because you got two households. Whereas a husband and wife living in one household can just have one of those things and they can both use them. So this is literally double the market size, right? And an economy where 70% of the economy is based on consumer consumption. 70% of the S&P 500 is just consumer, right? And this is giant. It's huge. Talk about a way to stimulate the economy. Tell people to stay single or tell them to get divorced, right? And this sucks. This is bad for society. It's bad for culture. It's bad in so many ways sociologically. But the powers that be, the greedy powers that be, the politicians that want things to look better on their watch during their tenure, and the big corporatocracy that wants to make more money, you have to admit that this would be a part of their strategy, right? And so they want Hollywood to make divorce more acceptable. They want Hollywood to discourage the idea of marriage. And so you see all these movies that like subtly reflect all of this stuff. And it's just interesting, because this is an increase in market share for companies. There's just no question about it. Adam, you're married, you got 4 kids. Comment.
Thanks for that happy view of life and society.
Right. Hey, listen, I'm not here to make you happy. I'm here to make you money. And by understanding the trends, you can make money. But hopefully happiness will result.
Now, this chart is what has actually happened. This was 1990 to 2010. So this has already happened. If you go to the next slide, we're going to see what they're expecting to happen. And this one is even better for us as investors.
All right.
If you look at this again, the Southeast is actually going to outperform Texas and Florida, and it's going to grow at 24%. And they're expecting household growth to grow, I think it was somewhere in like the 15 or 16% over the next 10 years. So this is their guess. The book at the time was written in 2015 for 2016 through 2025. So Texas is still growing 15%. Florida is at 12%, and the Southeast is at 24%. That is all higher than any other part of the nation. It's higher. And on the left, we start breaking it down into areas.
Right.
Like we've talked about, you've got your urban, your suburban, and your rural. And if
Right.
you look
And what's
at,
what's what's interesting, Adam, here is I'll bet you, when we look at the 2010 to 15 and the 2015 to 2025, those are projections. Okay. So,
well, oh yeah, yeah,
you can lop a few percentage points for sure off of the urban growth and just put that as into the suburban share of the market, I think, right?
yeah. I mean, they were predicting it to go up to 21% urban because people were moving, older people who wanted to, well, not older necessarily, but people, empty nesters who wanted to move into where there were more amenities. And then you've got the younger people moving out wanting to stay um, in the urban areas. But then as they get older, they start to move back out to the suburbs, they have kids and they move back out there. So they actually saw the urban dropping from 2015 to 2025. And that has definitely happened. So you're looking at potentially 79% of the growth happening in suburbia. I mean, that's where you're able to make it work. That's where we're able to find properties. Is
Yeah.
suburbia is growing, and this was before the pandemic. So I
Right.
would say
Right.
you could even drop probably 4 to 5% off urban, because I don't see many people moving there. I don't hear any of my friends talking about moving to the downtown core, but I've seen friends looking for properties in suburbia.
Yeah.
Definitely have.
Yeah.
So
Well, now, just to be a fair analyst and statistician on that, you're in the age group where there's a lot of family formation. So your
true.
friends, if they're single, they're more likely to live in an urban area than if they're married, right? So
Yeah.
you got to adjust for that a little bit. But I totally agree with you. My friends who are single and married, nobody's talking about moving to New York City. Okay.
Yeah.
Nobody's talking about that. Nobody's talking about moving to, downtown LA or, the more dense areas of LA or San Diego or Seattle or anything like that. And as I tried to post yesterday, but Facebook was censoring me, which is totally freaking ridiculous. These social media companies and their censorship is very bad news. And I posted that link from the Justice Department website about how they have literally declared New York, Portland, and Seattle to be anarchy zones in essence, right? This is absolutely crazy. Yeah.
And this
So
is
huge
completely,
trend.
anecdotal, but I think I don't remember if I said it on a stream or a show before, if I just said it talking to you. Um, and here in Austin, whenever we moved here, the market was hot. People were going crazy trying to buy in the suburban area we are. And then it died down. And then just when the pandemic hit, I started getting text messages from my realtor saying, hey, if you see any coming soon, tell me. Because once they hit the MLS, it's gone. They're snapped up. There's so much competition.
When you say if you see any
But
coming soon, you're talking about houses hitting the market.
houses for sale. So that if there are
Right. Yeah.
any homes in your suburban neighborhood that are coming soon, let me know. I have people who want to buy them right now.
Yeah. Yeah.
And you know what it
Absolutely.
reminded me of? It reminded me of all the new construction that we're selling that aren't even built yet, but people are lining up to get.
Yeah. Yeah. Some of our clients are literally have purchased properties now or signed up to purchase properties that won't be delivered until early 2021.
That's me.
21. Yeah.
Yeah.
Right. So yeah, it's just unbelievable. Yeah, it's the demand is absolutely staggering now. I know there are people out there who are saying, "Oh, the end of the world's coming," but I don't know. I don't know that it's coming.
Even at the end of the world, people need a place to live.
Yeah, right. And, well, they need it more so, and we discovered that during the pandemic because people home became the center of the universe, as I said. So we got a couple. Feel free to make some comments here, folks. We can get a couple questions, comments in. So good morning, Tony. Good morning, Gold Color. Good morning, Robert from Michigan. Yes, tell us where you're located, by the way. And we got to always ask Robert, where on the hand are you located? Michigan's like a hand, right? So point there. that's what Michiganders always do, right? And then Metal Bum says, "Hey there, good morning." Okay, so let's go to the next slide, Adam.
Yeah. So this one is looking at mortgage rates versus home prices, and it's no surprise and home affordability, sorry. And it's not going to come as a surprise to listeners of the show. Interest rates have dropped dramatically, and it lowers the payments, and it causes the home affordability to start going up. But then what happens is, Jason, home affordability goes up, so everybody wants to buy.
Yep.
So it
So
starts
you have no supply.
yeah. And now this was also, remember, this was 2015. That first line down there, I don't know if y'all can see it. The line where the blue line's around, that's 6%. We're not at 6% anymore.
Yeah.
We're at the bottom of this graph.
Right.
We're at 4% now.
That's
So
amazing.
So as you were talking about people buy based on payments, not price, as it goes down, it's showing you right here, as the payments get lower, home affordability gets higher. And that's even more important as this line goes lower and lower and closer to zero. So
And
home affordability is high.
Great point, Adam. And the word of caution here is the media deceives you. Oh, imagine that. Really? Nobody's surprised that the media would deceive us, right? Nobody trusts the media anymore, the mainstream media, or as Sarah Palin used to call it, the lamestream media. I love that, by the way. That's good. But the lamestream media, this isn't some big political conspiracy. It's just that they have to talk in sound bites because, there's a very short amount of time that they can talk and explain anything. And so, what you see here is virtually every discussion in the media, in the mainstream media, is home prices. They'll show you a home price chart. You'll be looking at CNBC. They'll put a chart on the screen. It'll say home prices are, as high or higher now than they were at the prior peak. And look what happened then. There was a big, crash. Folks, that doesn't make any sense. It doesn't tell the story. Why? Because, of course, real estate is a multi-dimensional asset class. And as Adam just explained, nobody buys a house based on the price. They buy it based on the payment. That is the true cost of the home ownership, the monthly cost, not the overall cost. Folks, if everybody was so concerned about the overall cost, they would be wondering, why houses still aren't $60,000 like they were decades ago, right? The interest rates are dramatically lower, and they're buying based on that monthly payment. The other point of caution I want to give you is that, people say, oh, well, the interest rate went from, 6% to 3%. So it went down 3%. No, it did not go down 3%. It went down by 50%. Okay. So just when you look at these charts, realize, of course, that's the comparison. It's not a 3% change. It's a 50% change. Remember, the question is, as my followers have dubbed it, the Jason Hartman question, compared to what, right? So you have to compare that old interest rate with the new interest rate. And you see there, in that example, 50% reduction. So yeah, Adam, that's staggering. And by the way, I shared on one of the others an example of a 2006 mortgage at the interest rates then today buys you, that was $100,000 mortgage in that example I gave before. I don't have it on the screen right now. But now you can get a $170,000 mortgage approximately for the same monthly cost. That's the issue, right? You're getting $70,000 more, 70% more buying power for the same monthly payment. It's truly incredible.
Yeah. And so this next chart is, as we're talking about monthly payments, this is, people want to get their housing costs in that 30 to 40% range. So this is showing us and this is from July, it goes up to July of this year. And it shows you that as the interest rates have dropped, and this is when the interest rate had gone down to 2.98%, which it's still hovering right around. I heard that it went up to 2.87 recently. And it shows that the home affordability is so great that your payment, the average payment, is only 19.8% of income. Anybody, pretty much anybody who can afford a down payment can afford a home right now.
Okay. Now, Adam, this is good, and I want to make a comparison. I want to do a compared to what on this one, okay? And this is I'm so glad you brought this chart, so great job. Let's give Adam a hand, everybody. He's got it. I wish that clapping would not go so long. I need a sound effect machine with a shorter clap. Okay. But Adam wearing his rugby shirt there, just like you want a rugby match, right? Not a game, a match.
Match, yep.
All right. Yeah. See, I got the correct terminology. So you've won the rugby match here on the affordability thing. And here's why. Okay. Think about the arbitrage. I talk a lot about arbitrage, and I like to give things simplistic definitions. So arbitrage, the simplistic way to understand that important word is exploiting the differences in things. That's what arbitrage is. You're exploiting the differences in things. Okay. So think about this arbitrage. You buy a property, and that property is a 19% for the payment to income ratio, right? But when you rent a property, when you take that same property and rent it, I'll bet you that your tenants are paying a 33 to 40% of payment to, or rent to income ratio. Okay. That's what they're 30 to 40% is typically what the renter is going to pay. And with that in mind, I and this is not new for my regular followers, but I just got to say it again because it's so important. Look it, folks, indentured servitude is illegal. Slavery is illegal. Okay.
I hate this example.
Yeah, you hate this example. Okay. I think this example is a good one. But if you want indentured servitude, then all you need to do is buy a bunch of properties and get your tenants to agree of their own free will. Okay. They're agreeing. They're not forced to simply agree to share 30 to 40% of their total household income with you every single month. So think about that. A lot of people think, okay, well, I want to go into business. I want to get rich in business, and I want to start a business. And one of the things you're really doing in business is you're arbitraging, right? So in a professional services firm, it's an easy example to use. Accounting firm, law firm, management consulting firm, whatever, right? And so typically you'll hire people and you'll pay them X amount of dollars per hour. Say they're professionals, and just in this example, they make $50 an hour. That's what you pay them. But when you bill them out to a client, you charge the client $200 an hour. So it's literally a 4 times markup, right? That's kind of the pretty typical. Sometimes it's even greater. I have one friend that works at a big tax and management consulting firm, and she gets billed out at insane rates, like hundreds and hundreds and hundreds of dollars an hour, almost $1,000 an hour, because she has this very specialized knowledge when it comes to tax nexuses and strategies for that. But she gets paid like a tenth of that. It's crazy what the arbitrage they get there, right? And so basically what you're doing is you're saying to your tenant, okay, instead of having an employee, right, your tenant is just going to work for 10 to 14 days of every month to pay you. That's what goes to your rent. 10 to 14 days of the first 10 to 14 days of every month that your tenant works is yours. That's your rental income, right? So it's pretty amazing. It really is. It really is. And sorry if you don't like my example, but it's just reality.
The indentured servitude is better than when you drop the slave.
Okay, all right. Well, listen, there's no secret. I mean, many people have accused the Federal Reserve and the U.S. government, or all governments around the world, and the big corporations, the corporatocracy, of making everyone into a debt slave. Okay, it's the student loan scam, which is a total freaking scam of epic proportions. It's 1.5 trillion with a T, it's $1.5 trillion or so in student loan debt slavery. I call it the government student loan debt slavery complex. It's absolutely disgusting. They're selling these largely worthless degrees too. Not all of them. STEM degrees are very worthwhile, of course, but a lot of these degrees that they're selling are a scam. Okay, Adam, this is incredible. Just tell us about this a little bit more, because I want to stay on this slide just for a moment. It's so significant.
Yeah. So, I mean, it really just shows that, and it's going to cost a little bit more than the 19.8%, because this is just the housing payment. It doesn't include your home insurance, your any other
property taxes
or anything like that. Yeah. Property taxes. It doesn't include everything, but it really shows, it kind of emphasizes the previous graph that, I mean, money is getting free at this point in time. And when money becomes free, things get cheaper. And when things get cheaper, the demand for them hikes, and then the prices go up. And
right.
we're starting to see that now. I think I read an article this morning that said median home prices are up 11% from just the previous month or two. I mean, it's getting crazy out there, and the Federal Reserve has made it very clear that they do not see any danger of inflation until 2023 at the earliest, at the absolute earliest. But just because there's no inflation in the economy, the overall economy, does not mean there's not inflation in certain areas of the economy.
I'm so glad you said that, Adam, because
free money is going to make housing prices skyrocket.
Okay, so remember something, and that's very important what Adam just alluded to. There's a huge, the consumer price index, the CPI, the most widely used index of whether there's inflation or not, okay? And the Fed's target on that is 2%, of course. We've all talked about that many times. But it does not account for asset price inflation. What all of these things do whenever there's this quantitative easing, whenever there's this money printing, whenever there's the loose accommodative money policy, right? And the Fed, by the way, just to slightly modify what Adam said, didn't necessarily say that they didn't see inflation. I think they were even more cavalier about it. They alluded to the idea that they don't care if there's inflation. They're just not concerned about it. They think they can rein it back in when it happens. But the reality is, and folks, this is one of the reasons you've all heard the old saying, okay, the rich get richer, right? The rich get richer. Why do the rich get richer and why do the poor get poorer? It sucks. It's totally unfair. Well, the reason is that the rich are, or the upper middle class, or even the middle class that gets in the game of real estate investing, okay, or even the lower middle class that gets in the game of real estate investing. There's lots of social mobility in the United States, and there's a million rags to riches stories that we all know that, okay, or tens of millions or hundreds of millions of them actually, is that they get an asset, okay? They get a property, and then they let that loose money policy inflate the value of it, and then they get another property, and then they get another one, and they keep doing that. Whereas the poor don't participate in that game, okay? And they also don't have good financial discipline. They usually do fall into instant gratification, and they buy things that give them pleasure instead of producing wealth. And you've always got to delay gratification. To grow in anything in life, it requires delayed gratification, right? The ability to wait for longer term, larger rewards. So instead of buying a jet ski, you buy a rental property. Instead of buying that nicer car, or spending all your money on expensive designer clothes or whatever, you buy a property, you buy an asset, something that produces income for you. And then you're in the game, and then you're on your way, and you buy those luxuries later. All right. So also, it's booming in Tucson. Please says, Sarah says, hi guys. Hi, Sarah. Metal Bum says, thanks, Adam. Yes, Adam, good job on this. And then please says, but no good inventory to buy, only overpriced crap on the market. Oh, please. I'm glad you brought that up. let's get your head on straight here. Okay. The question is, compared to what? Compared to what? How do you know there's only overpriced crap on the market? Seriously, how do you know that? You know that because you're comparing it to what was for sale a year ago, right? Or what was for sale 5 years ago. And every deal starts to look good in the rear view mirror. There is almost never a buyer who feels the day they decided to buy the property that they stole it, that they got some incredible, I mean, occasionally, but that they got some amazing, incredible deal. The deal became amazing later. Okay. It's, it's like eating healthy and going to the gym and working out, right? It's like, okay, you have a certain condition of your body today, but with a certain amount of eating right and working out and time, you create a better body, right? That's the idea of, physical fitness and health consciousness, right? And so that's the same with your properties, but largely the economy just does it for you. You don't even have to do anything. Yes, you can improve the property for sure by fixing it up and so forth. But this idea that everything is overpriced and all the inventory is junk. I will bet you, oh please, that's the handle, oh please. I will bet you that in a year you're going to feel that you can't even get the deals you can today a year from now. So,
you'll hear Jason reading the Reluctant Investor's Lament and be like, oh, yeah, that's right.
Yeah, absolutely. Look up the Reluctant Investor's Lament, folks. That's really good stuff. And Carrie says, hey, Tony. Okay, so let's go to the next one, Adam. And I think we're
This is the one you loved.
Yeah.
So for the most part, we've talked about how investment properties, single family investment properties, you said, Jason, usually once you get over about 225, 250,000, it starts getting really hard to make sense, right?
Yeah.
So if you look at this chart, when you get up to $200,000 of the new home sales that are available, that bottom line, you're looking at the red line is under 150, and that orange line is 150 to 200,000. That orange line is only at 10% right now. So 1 out of every 10 homes on the market is under $200,000. If you're looking for something under 150, it's that minuscule thing down there that's probably around 2.
There's 2% of it. So in other words, 2% of the market is single family homes under 150,000.
Yep.
10% approximately of the market is single family homes under or between 150 and $200,000.
8%, because the 2 combined are 10%.
Oh, wow. Okay, so 90% of the market is not eligible for investment, pretty much. Yeah, wow.
And this doesn't count the fact that this doesn't count the fact, and part of it is because homes under $200,000 just haven't been built for the last 10 years.
Yeah.
There's such a pent-up demand. Yeah. But at least for the last 10 years, they haven't built the under $200,000. And this is why our inventory is so low, is so tight right now, is because they don't exist. I mean, we're in most of our markets that we're selling properties right now, they are literally having to build the inventory to sell. Yeah. Our renovated markets,
it's very hard to build that inventory at the price and deliver it because all of their component parts, I talk about this in the Hartman Risk Evaluator that I teach, packaged commodities investing. All of those component parts, those ingredients of a house, the concrete, the lumber, the steel, the copper wire, the glass, the petroleum products, all of the prices, except petroleum products, admittedly, well, even lately they have gone up a lot, compared to where they were. I mean, prices have shot through the roof for petroleum products, but in the grand scheme of things, still fairly cheap for energy. But all those component parts have gone up in price so much that they can't deliver the house at that price anymore. So, oh, please's comment is a good one. I'm so glad you said that, even though I beg to differ with you. Oh, please. Because that's the way so many people think, and they're just gonna talk themselves out of it. not going to take advantage of the situation we're in. So, Adam, the rest of the chart just shows you the rest of the market, right?
Yeah.
And you see that a lot of it is dispersed into the more expensive properties. You've got a fairly big portion in the 200,000 to 299 price range. And remember, this is nationwide, so
Yeah.
prices obviously differ greatly in different markets. And then, over 400,000, quite a few properties as well.
Yeah.
So
That's where all the build's been, because that's where the money's been.
right. That's where builders can afford to build it and deliver it. And so that's good. Okay. Julian says, look at the deals on the 11 million people who are left unemployed, or look for deals for the 11 million people left unemployed. Once the foreclosure becomes a daily news topic, the market will start devaluing surrounding properties according to the area. Yeah, I don't know about that. Yesterday I interviewed Sean O'Toole, the founder of Foreclosure Radar and now Property Radar. And, I made a point about that yesterday, but I'm going to publish that episode next week. Okay. And he's an expert. He has the raw data. Okay. This is like not an uninformed opinion from him. Okay. And he's been on the show several times over the years. But he said, if you're looking for a big foreclosure crisis this time around, you're just not going to find it.
That's been my prediction for the last couple months when people have talked to me. Because, you've seen it already with all the forbearances, with all the eviction moratoriums. They're doing everything they can to keep people in their homes.
Yeah, right. And look at folks, there are several reasons this is, look, I want to make the disclaimer. The famous last words of any investor are, this time it's different. Okay, that's the famous thing every investor who's about to fall on their face says, but this time it's different. Okay, so at the risk of sounding that way, I am going to say, this time it is different. Okay, now don't hang me for that yet. Okay, there are some very significant things that are different. I get that unemployment is high. First off, a lot of those unemployed people aren't homeowners.
Yeah.
That's the first thing. They're, people that are in the lower middle level that don't own homes. They're renters. Okay. So now I know what you're going to say. Well, why do they can't pay my rent? I get it. That's another, look, it'll take me 20 minutes to go through this example if I discuss every little thing. So just more on the podcast. Okay. Just listen to the podcast. But the other thing is, the equity position for American property owners is pretty good. During the Great Recession last time around, people had no equity in those properties. When you have no skin in the game, you just take a walk away. You just leave. There's nothing to lose. You just walk. This time they have equity. And guess what else? This time those loans have been underwritten conservatively. The liar's loans, the ninja loans, those haven't been happening the last 10 to 12 years. And I know there are some examples of them, okay? But by and large, it's a non-issue, okay? And these people are not homeowners. Many of the unemployed people are not homeowners. And then, of course, you've got the political environment of just they want to keep everybody in their home, whether they be a renter or a homeowner. And so that's another thing. Adam, comments?
Yeah, I was going to say, if you're a politician and you want to make people mad, the best thing to do is to tell them to stay home so they lose their job, and then tell them they have to leave their house.
Yeah, I think that's working, actually. I think that's what politicians have been doing. But yes.
Don't go to work. But since you can't go to work, you can't live in your house. Yeah. So see you later.
So we'll wrap up in a moment here, but Please is back with another comment that says, Jason, prices go up here at $10,000 per month. It's tulip mania. I get it. I know it's crazy. Now, I don't know where here is because I don't know where you're located, but if you're in a good, normal, linear, conservative market like you would find at jasonhartman.com in the properties section, if you're there in one of those markets, okay, you can, if you're working with our team members, you can get yourself some properties. And I know it's discouraging and there are multiple offers. I get it. But remember, one of the things you're really buying right now is not the property. You know, people are too focused on the property when they need to look at it as a holistic asset. And a huge part of that holistic asset is the mortgage. You're buying the mortgage, not just the property. That mortgage at these incredible rates is a huge asset. Think about it. You get a mortgage today, you don't have to make the last payment, or your tenants, because that's who really makes the payment. We outsource the mortgage obligation to the tenant. They don't make the last payment until 2050. Think of all the sci-fi movies you've watched about what life will be like in 2050. Whether they be dystopian or positive, doesn't matter. The fact is, things will massively change, and the likelihood is there will be massive bouts of inflation between now and 2050, actually long before that, I think. So, just you gotta stop agonizing about this. I get it. I know how it feels. You feel that sense of scarcity, that sense of loss that you can't get a property, and it's hard. But you just got to outwork other people.
Well, it's not only that, but if you're in a market where prices are going up $10,000 per month, that's likely not going to be a great market for buying investment properties in.
Right. It's likely a cyclical market.
Yeah.
Yeah. Please post. Oh, please. Oh, please post where you're located. Okay. Or where you're looking. Yeah.
Yeah. So, I mean, whenever you've got prices going up that high, you either have really high values to start with, or you're just going to get priced out of the investment properties really quick at that rate.
Absolutely. Okay, so let's move on, grab these questions. And Adam, I think this is the last chart, right? Yeah, it is.
Yeah, that was it.
So these last ones here, let me just grab those. I'll make this a little smaller, make us a little bigger. Oh, wait, that doesn't put both of us on the screen. Okay. So Hookshot is asking, I'm selling an investment property in North Scottsdale. I love North Scottsdale. Scottsdale is such a great place. I miss it. Which has appreciated substantially over the past 5 years. Since it's in an IRA, I can't pull cash out. Should I sit on the cash and wait for a correction? Okay. Well,
when is the correction going to get here? How will you know?
Yeah, that's the big question. But first, let's address the actual dynamics you're talking about. So it sounds like you have this property and it's owned by your self-directed IRA. You say, I can't pull cash out. Well, I would argue that that's not true. You can't pull cash out into your normal bank account, but you can pull cash out and leave it in the plan, in the self-directed IRA, and you can use that cash within the IRA to buy another property. I think. I don't know what would be wrong with that, unless the issue you're saying, and folks, these questions are, since we can't go back and forth and they're not always complete, we have to sort of assume what you might be thinking, right? And one of the things you might be also saying is that, there's not a lender that will give you a cash out loan on a self-directed IRA property, and that may well be true. But, look at the stuff that our former guests and speakers, Garrett Sutton and Tom Wheelwright, talk about these self-directed plans. They're really, and I don't mean self-directed plans, I just mean IRAs in general. They're not as great as people think when you say compared to what, and you think of, what can your money just do on the open market? Even if you pay tax and pay a 10% penalty, sometimes it can actually be worth pulling the money. Tom Wheelwright is not a fan of these plans, and neither is Garrett Sutton. So check out what they've written on it. They've been on the show many times. I've, got by the way, if you want to search them, just go to jasonhartman.com and type in any keywords on our search engine, and you can find the podcast episodes on all of these topics. Yeah. And then the correction, Adam, you want to comment on that real quickly?
I was just going to say, based on what you've seen here and based on everything else, I mean, let's say you think $200,000 is too high a price for an investment property that you're looking at. Is 180 going to be good enough? Or do you want it to go down to 160 or 150? You're going to, where's your point? And based on what you've seen and what you're seeing in the market, that's anywhere from a 10 to 20 to 40% decline in home prices, I mean, your cash flow, if you look at the interest rates, the change in interest rate from 180,000 to 200,000 is probably what, 25 bucks, 25 bucks a month, I would say. So you're not
I don't know,
really
I'm not calculating it, but okay.
you're not really increasing your return all that much. I mean, it's an increase, but you can sit there and wait around for years to make an extra $20 or $25 a month cash flow and hope that the interest rates are going to be as low as they are today.
Yeah. In the rearview mirror, every deal looks fantastic. Okay, folks. So you gotta just consider that. Okay. Last couple comments here. Julian says, "Thanks for the insight."
Hookshot answered down below if you want to go. The lender won't refinance on a non-recourse loan within a self-directed IRA to pull the equity out. So you're right. It was the lender.
Yeah.
You might just have to wait that out, honestly.
Hookshot, I was thinking that, but you can sell the property inside the plan, and then the money is in your plan, and you can use the money to invest elsewhere. I mean, look at North Scottsdale is a very expensive market in most cases, and it's, that's not going to be a good performing market in terms of rental. I love the area, but again, it's not a place to invest. So you could sell that property. You don't need to worry about a 1031 tax deferred exchange that, by the way, communist Joe Biden, if he's awake, wants to take that away, just so you know. Adam, I know are you voting for Biden? I bet Adam is. I'm going to put you on the spot.
Whether I'm voting
maybe I should put it this way. Are you not voting for Trump?
I am going to not vote for Trump. Yes, that would be an accurate statement.
All right. So there you go. But you can buy 2, maybe 3 properties, maybe more. I don't know how much your property in Scottsdale is worth, but I would do that. Just get rid of that property. By the way, I have to make the disclaimer, we're not tax experts. We're not legal experts. So consult the appropriate professional. All right. Dominic says, Julian says, thanks for the insight. Looking forward to your upload next week. Oh, well, we're doing this like daily now.
No. Your upload with the foreclosure guy, I think, is what.
Oh, okay. About. Okay. Thank you, Adam. Yes. So that'll be next week with Sean O'Toole, and I think you'll like that episode. Looking in Charlotte, North Carolina, it's going up. Where should I go now? Well, go to jasonhartman.com and check out the properties. Talk with our team members. Talk with Adam, and they can help direct you, Dominic. That's what we're here for. Okay. The gold color says exactly Roth IRA, 2 properties, more money made. I'm not sure. Adam, can you decode that one?
I think it's supposed to be Roth/IRA, and
maybe.
I don't know what the 2 properties more money made.
Yeah, I don't know.
I'm sorry.
Means. So sorry. Okay, Hookshot, and we got that one. Okay, I think we can wrap it up. Adam, final comments and thoughts. Thank you for the info. Thank you for bringing that to us.
My final thought's going to be: there's no harm in reaching out and talking with us. Talking about what you might be able to do with your money. It doesn't hurt our feelings if you come up and talk to us and then decide, I'm going to wait 6 months. I mean, you may as well start forming a plan. Yeah. Now, whether that's invest right now today or tomorrow or 6 months from now, it never hurts to have a plan.
And really, there's much more than a plan. Form relationships.
Yeah.
Start assembling your team, even if you're not ready. So talk to Adam, talk to our other team members. They'll be happy to help you. Just go to jasonhartman.com for that. But also at the bottom of the screen, if you're watching this, I don't know, you might just be listening, but but be sure to go to pandemicinvesting.com and get your free mini book on pandemic investing. What we did is we sort of adjusted some of the strategies we've been teaching for a long time, some of the commandments. I think we added 2 new commandments to the 10 commandments there in the pandemic investing mini book. And that's totally free, no strings attached. So go to pandemicinvesting.com and get your free mini book there. And I think you'll really enjoy that and get a lot out of it. Adam, thank you so much for bringing this to us. Thank you for joining us. Thank you, everybody, for your great comments, questions, and thoughts. And please tell your friends about the podcast, about our YouTube channel, and so forth. And we look forward to seeing you next time. And until then, happy investing, everybody. Thanks for joining us.